Hello everybody, Bengala Tunji here. Welcome to the concluding part of the regulatory environment and the management of our organization and that of the shareholding or the ownership of it. Then we'll look at the director's responsibility, we'll look at the auditor's responsibility. Then from there we move on to the expectation gap. Then types of expectation gap, then how to close expectation gap. What is expectation gap? And we'll bring this series to an end by looking at professional skepticism. What is professional skepticism and the like. So as we move on, we implore you, if you are yet to subscribe to this channel, please go and subscribe to us, like us, click the notification button so that as we continue to release new videos, you can be notified on time. I would like to conclude on using the work of an expert that we started in part 1 by saying that experts should have their works documented, and for external auditor to put reliance on auditors experts or management experts work, they need to go through the report of the experts and verify how they go about their works and the job done before the conclusions were reached. This will give them the idea of the thoroughness and reliability of the work that the experts had done, and can to a certain degree help to take decision whether the work of the expert should be relied on or not. Because immediately we incorporate the work of experts into our report, it becomes our opinion. It doesn't really matter after that who said what or who advised on what. The report is seen as being consented to by the external auditor, and the liability comes to the auditor. So before we conclude that we want to use and rely on an aspect of work carried out by the experts, we must try as much as possible to go through their work, especially their report. So with this, we conclude on how to use the experts' work in our audit assignment. And please, if you've not joined us, then kindly go back to part 1 of the regulatory environment and listen to it so that you can catch up with what I just concluded upon. So we are moving on now to the meaning and nature of governance. The meaning and nature of governance. First of all, I want us to know that management and governance, they are interrelated but are actually different. While management is about taking decision and running the organization, governance specializes in ensuring that the organization is being run well. So the wellness of the organization belong to the people charged with governance. So while management runs the organization, the governing body ensure that it's being run well. Okay, having said that, corporate governance is the way in which the companies are managed and controlled. In particular, it focuses on the role of director and the responsibility of the shareholder. Don't forget, the directors are the management team, apex of the management team, and the shareholders are the owners of the company. So when we are talking about the governance or corporate governance, we'll need to talk about the separation of power, the ownership of the entity, and the management of the entity. The ownership belongs to the shareholders, but other stakeholders like the management must run the organization on a daily basis using the vehicle of directors, especially the executive directors, to run the organization. I read from my notes now. As a form of business entity, an important feature of company is to divorce of ownership from management. So we must separate the management of the organization from the ownership. The first group is the group of the owners, shareholders usually called, and the second group is the group of the management, in which the directors belong to. And the directors are functioning under agency relationship or agency agreements. That is, they are carrying out the wish of another party, and which is usually the shareholders. So the directors are to ensure the maximization of the shareholders' wealth. The directors have responsibility primarily to the shareholders and also to other stakeholders, and they must be accountable. They must be accountable. It's part of the responsibility of the directors to be responsible and to be accountable to other members of the organization. And in being accountable, they must ensure that records are well kept at various levels of the organization. They must ensure that records are well kept. They must be accountable to the shareholder for the resources put under them to be used. And they must give reports back to the shareholders. The directors are responsible for the preparation of the financial statements, like I said in the part 1. Even though other employees may and will definitely prepare the financials, like the accountants, account officers, CFOs, and the like. Even though those people will do that, but the responsibility of the preparation of the financial statement is the responsibility of the directors, because they must be accountable. They must put in place check and balances in form of internal controls to ensure the safeguard of the organization's assets The directors must provide access to the auditor for every level of information that auditors may require. It is their responsibility to ensure that auditor has access to every information that they require to carry out and to give their independent opinion. They must represent, and what do I mean by represent? They must be able to communicate to the auditor in writing, especially on the general aspect of representation and on specific demand that the auditor, in the course of their carrying out their audit, will be required of them. Unrestricted access to every level of staff within the organization. Directors must ensure that auditors are able to have access to people so that inquiries could be made and they could validate everything that they needed to do, Audit Committee. We've spoken extensively about Audit Committee in part 1, and I think we are good there. I think we should move on to auditor's responsibility. Maybe I should add to the audit committee's function by saying the audit committee is an oversight function. They have oversight function. That is, they are to look after the organization, especially when it comes to the area of financial and everything that surrounds it. Ensure that internal control is running fine, and if there is no internal audit department, they must ensure that they set the internal audit up and is running, and they receive the internal audit report as occasion demand, and they action it, because the internal auditor may propose, but the implementation of the proposal belongs to the management. So it's an aspect that they need to work on, review the report and the like. The financial statements unaudited for the year must be looked into, and they ensure that necessary parties are being called upon in form of external auditor to work on it and validate for reliability. Policies and strategy in respect of risk also belongs to them. They must be able to strategize and they should review the necessary risk and give advice to the other layer of management. They must ensure that the scope of work of both the internal auditor and external auditors are not limited in whatsoever way by other arms of management. They should oversee to hit that everything is being done right. So these are some of the oversight functions of the audit committee. Let us move on to the expectation gap.